cash flow, group cash flow. Let's talk about how this topic can be examined in the strategic business reporting examination. Let's make sure you understand the basic principles. My name is Tom Clendon, and I help students pass SBR. Now, what you need to know about cash flow is there are three headings. Operating, day-to-day. Investing, what do you invest in? Non-current assets. Financing, how do you finance a business? Debt and equity. Well, let's have a look at each of those in turn. Strictly speaking, with operating activities, there's two forms of presentation that is allowed by the standard: direct and indirect. If the company chooses to go for the operating activities direct method, it's a pure cash flow. It starts with cash received from customers, then has paid to suppliers, paid to staff, and paid to other operating expenses. You'll then have at the bottom interest paid, tax paid, pension contributions paid. And so it's refreshing. It's simple to understand for the investor. It's giving them new information as well. But it's not that popular with companies, perhaps because it gives new information, and perhaps because there's some cost involved in preparing the information. From an exam point of view, it's rarely tested. What is normally tested is the indirect method. And the indirect method, strictly speaking, isn't a proper cash flow at the beginning, because it starts with profit before tax. And it reconciles the profit to the cash, which I think emphasizes to all investors that profit and cash are two different numbers. Now, when we're reconciling profit to cash, one of the things we'll do is add back depreciation, because depreciation is a non-cash expense that has reduced profit but has not resulted in a cash outflow. So if your profit is 200, but the depreciation charged is 20, actually your cash is a bigger number. The 200, you'd add back the 20, and therefore you're adding back non-cash expenses because they've reduced the profit but not reduced the cash flow. And there's dozens of non-cash expenses that have been charged in impairment losses, increases in provisions, foreign exchange losses at the individual company stage, losses on the disposal of assets, pension costs, current service costs, past service costs, settlements and curtailments, finance costs, share-based payments. The list goes on. And what's interesting is that cash flow can't really be studied or thought about as your first topic, because it does interrelate with the other accounting standards that are tested at strategic business reporting. It's a lovely question to do on revision. It's a lovely bringing together of various topics. Of course, if there are non-cash profits, non-cash items in the P&L, they will be deducted, like a profit on disposal of PPE. At the very bottom of the operating activities, you'll have interest paid, taxation paid, and pension contributions paid. Everybody hopes that the operating activities is pumping out a positive figure of cash, because traditionally both investing activities and financing activities are probably going to be negative numbers, as we are about to see. Investing activities. What do you invest in? Well, if you're a bricks business, you're buying land, buildings, plant and machinery. If you are more of a clicks business, the cash that you are spending may be on development expenditure in creating intangible assets. But in the exam, it's a group cash flow. So you could be buying a sub. And you've just got to be a little bit careful that you understand the difference between the investment in the sub, which goes in the goodwill calculation, and the cash outflow in investing activities. Because not all of the investment in the sub may be a cash outflow. You could buy a sub for 100, and 60 of that is either share for share or deferred consideration, non-cash, and only 40 is cash. And then if you're buying a sub with a cash positive, that cash positive flows into the group. So you may have a sub with a cash positive of 10, and the investment is 100, of which only 40 is cash, but 10 comes in, so your net cash outflow when you buy the sub would only be 30. Good. Financing activities. Financing activities basically are debt and equity. So we raise cash by borrowing money, debt, increase in debt, or we raise cash by issuing shares. Just be careful that you don't automatically assume that just because share capital has gone up, cash has come in. It may be a share for share exchange. It may be a convertible loan note that has been exercised and turned into shares. So read the information in the question. Cash outflows on financing activities tend to be repayment of debt, so lease payments would come into that, dividends paid by the parent, and dividends paid by the sub to the non-controlling interest. Because remember, if the subsidiary pays a dividend to the parent, that's intracompany, and that will automatically be eliminated on consolidation. If there are control-to-control transactions, where you are buying shares from the NCI to reduce the NCI, or selling shares to the NCI, which increases the NCI, but there is still control to control, it's still a sub, then those cash payments would be reported in financing activities, because financing activities broadly involve debt and equity. If your group cash flow has already been prepared in a pre-populated spreadsheet, but you're then told, oh, something hasn't been taken into account, then you've got to take it into account. So, for example, you might have a figure of, in investing activities, a payment to buy PPE of 100, but you are told there's an acquisition of a subsidiary, and that acquisition of a subsidiary had PPE in it of 10. So you've got to make the necessary adjustment. Well, let's think about it. In investing activities, the original figure should show minus 100, representing the increase in PPE because of cash as a balancing figure. But when you take into account that PPE went up by 10 because you acquired a sub, the net figure you're wanting is 90. So the adjustment you are making is 10, and that needs to be a positive number to reduce the minus 100 to minus 90. I love cash flows. I love cash flows. And I think investors love cash flows too, because they're reliable. There's a faithful representation about what you're reading, because cash is free from accruals, judgment. It's free from judgments around policies, and it's relevant to investors, because they want to know about dividends, they want to know about going concern. Often people say cash is king. My name is Tom Clendon. I help students pass SBR. You can find more details on my website www.tomclendon.co.uk. Find me, follow me. Thank you very much for listening.